Greetings, we are from Group 4. We'll be presenting Issue and Ethics in Finance titled Accounting Fraud. My name is Nurul and Izzatie Binti Rosdin.
My name is Nurain Amirah Binti Zai'in.
My name is Nurul Alia Binti Tajudin.
Hi, my name is Hidayahtul Solehah Binti Mohamad Ismail Selloo.
My name is Noradlina Binti Redzuan.
Firstly, what is accounting fraud? Accounting fraud is the international manipulation of financial statements to create a false appearance of corporate financial health. Furthermore, it involves an employee, accountant, or the organization itself misleading investors and shareholders. A company can falsify its financial statement by overstating its revenue, not recording expenses, and misstating asset and liability.
So now I will explain the summary of accounting scandal involving Satyam Computer. In 1987, Ramaling Raju and his brother Rama Raju started a company together called Satyam Computer in Hyderabad in India. It was listed in BSE in 1991 with an IPO oversubscribed 70 times. Satyam received recognition for innovation, corporate responsibility and governance. Mr. Raju received the Ernst & Young Entrepreneur of the Year Award in 2007. The Global Peacock Award was awarded by the World Council for Corporate Governance in September 2008 to the company. Unfortunately, Satyam was the target of a massive accounting fraud less than 5 months after receiving the Global Peacock Award. On 23 December 2008, the World Bank announced Satyam had been banned from 8 years from conducting a business because they have been giving bank employees improper perks and was also accused of data theft and paying off employees. After several investigations, several BOD who are suspected of fraud were all detained by Indian authorities, including Mr. Raju and his brothers. So, for the summary cases of Transmile Group. Transmile Group Berhad is an investment holding company involved in the provision of aircraft engineering and maintenance services. In 2007, the company had an accounting controversy. The director had been accused of overstating income and making a misleading revenue claim as far back as year 2004. It then resulted in negative consequences towards the company and its shareholder. Then their issues of corporate governance and business ethics were raised to the fore. This accounting scandal all began when the business missed the deadline for submitting its audited annual accounts to Bursa Malaysia for distribution to the public for the fiscal year that concluded on December 31, 2006. In this case, the fraud wasn't detected by the external auditor, but through a special audit of the company's account by Maurice Roland, it was discovered that the revenue was overstated by 622 million ringgit Malaysia from 2004 to 2006.
So we move to the mechanism issue for the Satyam company. The company launched Satyam Info Safi in 4 years, providing back office outsourcing service to a range of clients in the US and Europe. During that year, Safi, which had operational process in 30 countries and was the first Indian company to be listed on the Nasdaq. In 2007, Satyam was named the official IT service provider for the FIFA World Cup in South Africa in 2010 and the FIFA World Cup in Brazil in 2014. In the same year, Raju was given the name Ernst & Young Entrepreneur of the Year for growing his IT firms to over 50,000 employees. Got numerous awards and accolades prior to Raju's shocking admission of numerous manipulation and fraudster at Satyam. The company fell at the start of 2009, making it a memorable start to the year. Satyam actually cash and bank balance was 65 million, whereas the inflated balance was 1.3 billion. The inflated accrued interest was $7.7, but there was none. The accurate liability was unknown, but the inflated liability was 2,052 million. The mechanism of issue for the Transmile Malaysia is the first issue arose when the company failed to submit its audited annual report for the year 2006 to Bursa Malaysia within a period of no more than 4 months from its year-end report. Due to a lack of supporting document, the company external auditor, Deloitte and Touch, refused to approve the company's annual report in May 2007. Following an investigation, it was discovered that the company had overstated their revenues and profits since 2004 by a total of 622 million. After calculating the actual amount, it was discovered that the company actually has a loss rather than the profits stated in the company finance statement. The company's share price has dropped from 14 ringgit to 8 ringgit as a result of the scandal. The company accounting scandal occurred because the BOD conveniently delegated responsibility for managing the company and monitoring its performance to its agent and management. Due to massive drop in the company's share price, which peaked on the January 2007 at 14 ringgit 40 cent and fell to 4 ringgit 64 cent, the shareholder finally suffered a loss on their investment and the company was removed from the exchange list on May 2011.
The first problem that caused the company to collapse is due to having problems with the role played by CEO and CFO. Satyam, CEO Raju and CFO Badalamani did not perform their roles properly. Due to their illegal activity that results in hiding the true financial data, the company's investor, stakeholders and client did not even guess about the catastrophic situation with the matters in Satyam. However, in the case of Transmile, Transmile Group CEO Gan Bon An has advanced at least 35 million ringgit Malaysia of his own money to 20 different dormant firms, only to show auditors that the company had business transaction, which means it's a fake transaction. Furthermore, drawbacks in audit are also one of the key problems. The main role of an audit committee in any company is to make sure that its activity is transparent and clear to all stakeholders. In the case of the Satyam and Transmile Group, however, the audit committee did not perform its function. Such action led to the failure of the company's control system and did not present a true picture of the financial matter at Satyam and Transmile Group. The audit committee did not perform the necessary role in distributing false information about the financial matter in Satyam and Transmile Group. The failure of the audit committee to provide the board with realistic facts negatively affected the organization performance. The next problem is problems with disclosure and transparency. One of the key to success in business is providing the transparency and disclosure of the company's materials so that the real state of things could be seen and evaluated. In the case of Satyam, neither transparency nor disclosure was provided. The data provided by CEO, which is Raju, did not reflect the real state of things, which led to investors losing huge sum of money without even guessing it. In the case of the Transmile Group, the board of directors wants to conduct a special audit on issue raised by external auditors. It was later found, amongst others, that the revenues and profit have been materially overstated. The last but not least problem is the failure of independent director. The failure of Satyam was closely associated with the role played by independent director. These people were supposed to control the company's activity. However, they did not express either interest or concern about the state of things in Satyam. They continued to keep silent for several years while knowing that such a way of conduct could be harmful to the company's stakeholders. However, in the case of the Transmile Group, Chin Kim Fyong and Shukri Sheikh Abdul, as the company's independent director, have been accused of misleading financial statement to the stock exchange.
There are several solutions for the issue that have been taken by the company itself. Firstly, by arrested people who are engaged. In the Satyam case, Raju was arrested and charged with forgery, breach of trust and criminal conspiracy. Yet, for the Transmile case, the director Gan got a warrant of arrest but 1 day imprisonment. Second is levy a fine and an investigate penalty. In Satyam, PwC license was suspended for 2 years and Satyam cannot do business for 8 years. Then, in the Transmile case, the Security Commission imposed a fine of 2.5 million ringgit Malaysia against Gan. Next, the solution from these companies assigned a new board of directors, recruited Goldman Sachs and Avendus Capital to assist in expediting the sales in the Satyam case, and selected Dr. Ling Leong Sik as its independent and non-executive chairman of the Transmile case. We go to the proposed improvement of solutions model. Firstly, it's by create a fraud policy. It is by developing, publicizing, and executing a fraud policy that specify anticipated employee behavior, forbidden acts, how fraud should be reported, and the consequence. Next, through educate personnel about fraud prevention. This involves the engagement partner ensuring the audit team's quality and teach the personnel to honest in carrying out work, not taking bribes and brave to reveal the right things or truth. Lastly, by training the management board, which is develop internal controls or structure and be aware of the condition that the management need to look for. And establish several conditions for the recruitment of director, which must have sufficient expertise, abilities, and experience.
We go to the theory of finance. In the fraud scale, there are 3 factors that lead to the occurrence of fraud, which are situational pressure, opportunities to commit fraud, and personal integrity. The violations of ethics, honesty, and responsibility are the essence of the action of accounting fraud. From the fraud scale, it can be found that the three factors causing fraud relate to each other. This theory can be related with the Satyam case when Mr. Raju created records for fake employees and withdraw salaries on their behalf. He used his computer to create a number of bank statements adding money that did not exist to the balance sheet. So it can be seen that he is dishonest and has a low set of moral values while managing his company. For the Transmile accounting scandal case, it has been discovered that the business overstated its revenue and profit in the financial statement. Therefore, it can be seen that the board of directors has conveniently left the responsibility on the managing the company and monitoring the company performance to its agent and the management.